Good morning, it's Jeffrey Christian of CPM. It's about 9:40, just before 9:40 on Friday morning, the 10th of December. I was going to speak today about the relationship between gold and oil. Some viewers have asked about it. We do talk about it in our gold yearbook, and we do have a chart showing the gold and oil prices in our annual gold yearbook. But I was going to talk about that. Then the November U.S. Consumer Price Index data came out, and very interesting morning so far. So I've decided to talk a little bit about inflation first, hopefully not too much, and then gold and oil. And I'll talk a little bit at the end. I'll just point you toward where you can read about our views for gold, silver, platinum, and palladium in 2022. But let's start with inflation. And the interesting thing is the data for November came out is very high, very negative. It's clearly the kind of data that Jerome Powell and Janet Yellen have been trying to prepare us for, showing much higher inflation. The interesting thing is that when the data came out, the stock market didn't fall, interest rates didn't rise, and gold and silver barely responded. Initially, in the first 10 minutes or so, or half hour, gold was only up a couple dollars, and silver was up 2 or 3 cents. They have risen a little bit more. Gold's up about $7, and silver's up about 16 cents as we speak, but they are within the ranges of prices that have held since the beginning of December, at least, when we had that big sell-off toward the end of November, beginning of December. We're trading in those ranges. So gold and silver prices haven't really responded. Investors didn't look at the CPI and say, oh, this is inflationary and I should be buying gold and silver. You can see, again, the blue line is headline inflation, including food and energy. It's gotten up about 7%. And the core inflation, which excludes food and energy because of the volatility in those sectors, is up around 5%. I like to look at it on a month-to-month basis, and on a month-to-month basis, it's scary. We're still at 0.8% increase in prices in November compared to October, and October was 0.9, which matched the high that we saw in July. So you're seeing high inflation, but the really concerning part, and you probably can't see this, nor can I, is that the inflation was much more general. Now, the big jump in inflation continued to be petroleum-derived products. And that's a little bit strange because if you look at West Texas Intermediate crude prices, they started November around $83 a barrel, and they fell to $65 a barrel during November. But WTI is the wholesale price at, well, not the wellhead, but at the collection point near the wells in Texas and Oklahoma. So that's the wholesale price. And the November consumer prices reflected the fact that wholesale prices had gone from $62 in the middle of August to $84 for much of October. So the earlier increase in wholesale prices was being passed through to consumers in November. That's important to know when you're looking at that month-to-month data. That means that given that the price fell to $62 by the end of November, and has been trading between $62 and $72 or so, $75 since then, that the price passed through to consumers in December and possibly January could be a little bit lower. But you're seeing very high, I mean, if you're looking at year over year, 58% increase in some petroleum products. But the worrying something is you're also seeing energy services, natural gas provision, also rising. And you're seeing products, food prices are higher and problematically higher. But you're also seeing other, what the Bureau of Labor Statistics calls commodities, other goods, other than food and energy, also have been rising. And then you see auto, used cars are up 29% or so, but new cars are also up 11%. And then you're seeing the consequences of the supply chain disruptions. There just aren't enough truckers. We don't use rails. We don't have last mile delivery the way we used to in the good old days. So you're seeing the consequences of the delays in goods due to supply chain interruptions now filtering through across goods. And you're also seeing some upward pressure on the costs of services, partly because of the ongoing disruptions in the labor market. So it's interesting that we are seeing higher inflation. It's not as concerning to me as it is or seems to be to a lot of other economists. I do think that a year from now, we'll be looking at much lower inflation figures, especially on a year-over-year basis, because this seems to be the worst of the tempest right now. But we have to get those supply chain issues resolved. Meanwhile, you have bigger issues with the ongoing hostilities between the United States and China and the rest of the developed world, Canada, Europe, Australia. And those issues will continue to apply inflationary pressures in 2022. So inflation the data was bad, but the markets really didn't blink so far today, and probably they won't. Gold and oil, the chart of the gold price and the oil price. And people will say, as they say, oh, the gold silver ratio ought to be 70 or 38 or whatever. They'll just pick a number. It might be the average over a period of time or whatever. And they say, oh, there it is, and there's a very close relationship between gold and silver. But when you look at it, it's about a 78% correlation, which is actually pretty high for gold and silver. Correlation with gold and oil is much lower. There is a relationship. There is a real economic relationship between gold and oil prices. But if you look at the price relationship, it's not so great. And if you look at a gold oil price ratio, you can see that it's varied from 10 barrels of oil that an ounce of gold would buy to 35, 40. It shot way up when gold prices rose last year, got up to 60 barrels of oil at a time when oil prices were low and gold prices were at record high on an intraday basis. It got up to about over 60 barrels of oil per ounce of gold. And now it's back down to about 25. So you can see that the price correlation, the price relationship isn't all that tight, but there is a real economic factor involved in the relationship between oil and gold. And that's what I want to talk a little bit about today. Oil price changes have an effect on economies and other assets. Oil comes from a lot of places that have a proclivity toward holding wealth in gold. The Middle East, Islamic states in the Middle East, other states in Latin America and West Africa, and Russia. So when the oil price rises, you will see those countries flush with money in their export revenues and in their treasuries. And you will see them flush with US dollars, because most of the oil that is bought and sold in the world is still settled in US dollars. And oil price increases have an effect on overall economies. They're good for oil exporting countries. They tend to drain revenue or money from industrial countries that use the oil and import it or use their own oil. So you can see that when oil prices rise, economic activity will be constrained because more money is being spent buying oil products, and that reduces the amount of funds that are available for purchasing other goods and services. It can have an effect on contracting economic activity. And it can have a knock-on effect on restraining the stock market, although there are other factors that drive the stock market these days that have changed that relationship. You also have an inflow of US dollars into oil exporting countries. They will sterilize their petrodollars by selling the dollars, buying other currencies, and buying gold. Conversely, when the oil price falls, those countries don't have excess reserves, and so they won't be buying gold. If you look at the post-Soviet era in Russia, there was an extended period of time when the Russian central bank and government wanted to buy gold and add it to its monetary reserves, but it didn't have the foreign exchange to do that. And an enormous portion of the tax base for the federal government in Russia comes from oil and gas production and exports. So when you saw the oil price fall very sharply in early 2020, Russia, which had been buying gold consistently for several years, stopped buying gold. They've restarted in recent months this year, but for probably more than a year, they were out of the gold market as buyers because their foreign exchange earnings and their tax revenues on a federal government basis were down sharply with the oil price. As oil prices rose, they had more money, and they have now resumed buying gold. So there's a real economic relationship between rising and falling oil prices and rising and falling gold prices. When oil prices rise, it tends to cause a lot of excess dollars to accumulate with oil exporters, and they tend to buy gold with some of that money. And it tends to have a negative effect on economic activity, the stock market, and other assets, which then will actually cause investors in the industrialized countries to also be buying gold. So there is a real relationship there based on real economic activity, but it doesn't necessarily reflect on what the relationship ought to be. So anybody who says, well, the gold oil price ratio should be 20 or 25, 30 or 35, isn't really studying the math. That's gold and oil. In terms of where CPM Group thinks gold, silver, platinum, palladium are going, we have written an article, a relatively short article for the Northern Miner. It's available at that link at the bottom of this page, and it is our outlook and expectations for gold, silver, platinum, and palladium in the coming year. You can see the title, and then another year to disappoint your rational expectations. Yeah, in a nutshell, we're still positive on gold and silver and platinum, less positive on palladium, but we don't have irrational expectations that silver is going to be $100, that the world's going to run out of silver, that gold's going to $10,000, or that the world's collapsing. We think that rational expectations of modestly higher gold prices and silver prices and platinum prices in 2022 will be met, more or less, but we don't have an expectation that those people who are waving their arms and telling you that the world's falling apart and that silver's going to triple digits and gold's going to $10,000. I think that those irrational expectations will once more be disappointed in 2022. Hate to say it, but that's the way the world is. And look at the bright side. If the world doesn't fall apart, you don't have to worry about that. Now, again, we have our yearbooks coming up in the first half of the year. We have 4 seminars that we're working on. 3 of them will be online seminars. Platinum Group Metals in late January, Energy and Metals in early February, Silver in early March, and then the Future of Gold Roundtable with the IPMI, which will be a physical one-day roundtable discussion in early April here in New York. You can find out more about CPM Group at our website, cpmgroup.com. You can sign up and become a client of ours, buy our research, retain us for consulting time. We do asset management. We also do commodities management work. And we provide advisory services for both the buy side and the sell side on investing in commodities assets. That's all I have for today. Stay warm if you're in the Northern Hemisphere, and we'll talk to you next week.